Hello and welcome to the AJ Bell Money and Markets podcast. I'm Charlene Young.
And I'm Danni Hewson. Thanks so much for joining us. There's no shortage of drama again this week. The US government has officially shut down for the first time since 2018. We've had the Labour Party conference making headlines here in the UK, and we've got plenty of corporate and personal finance news to unpack as well.
Yeah, here's what's coming up on today's show: that US government shutdown, why it's happening, who's blaming who, and what it could mean for markets and the wider global economy. Over here in the UK, as Danny mentioned, it's Labour Party conference week. We'll dig into Rachel Reeves' big speech from Monday, what it told us, how markets reacted. We've got some revised GDP figures. In the corporate world, GSK is reshaping its business. Exxon is cutting jobs and oil prices are looking subdued. Plus, Greggs is back in the spotlight with its latest trading update following last week's marketing stunt. For our interview this week, Danny, you sat down with Jacqueline Broers from the Utilico Emerging Markets Trust. And in personal finance, I'll finish up by talking about what to consider when accessing your pension tax-free cash, and the quite frankly astonishing news from HMRC that over 750,000 matured child trust funds have still gone unclaimed. And let's start with the big one. The US government has officially shut down. Now, we're recording Wednesday, the 1st of October here in the afternoon UK time. And as Danny mentioned, this is the first shutdown since 2018.
Yeah, it's an interesting one. I was looking back at all the shutdowns that we've had in the past, and there have been a lot, but most of them have lasted a day, 2 days, 3 days. And it was interesting that the longest shutdown that there has ever been actually came during Donald Trump's first term in office back in 2018, as you say. That was for 35 days the government was shut down for. And the disagreement then was all about the funding for his big, beautiful wall. This is about his big, beautiful bill. Now, both parties blaming each other, but here is the situation. Republicans control both chambers of Congress, but they don't have the 60 votes that they need in the Senate to push a spending bill through. So we are now at a stalemate, and that means the government is partially closed. So, as I said, the last one was about funding for a wall. This one is about healthcare, with the Democrats saying that they refuse to back a bill which would make it harder for many Americans to afford healthcare. Now, as we say, it is a partial shutdown. And did you ever watch The West Wing, Charlene?
I did. CJ found
I
here, right here.
oh, I was a huge fan of The West Wing, and I do remember one of the episodes where the government shut down, and it was all about the budget back then again, and whether or not they would get this continuing resolution which would allow things to go on for a few more weeks while they found agreement, and they couldn't get that, so everything shut down. And at the time, the First Lady was cooking a chicken for the UK Prime Minister to come and have dinner in the White House. Absolutely loved it. But then they finally got a budget passed. At the moment, things are looking pretty difficult. There is a great deal of space between the two sides. So essential personnel will keep on working. So like the military, air traffic controllers, that kind of thing. But they won't get paid until after the shutdown ends. Now, members of Congress, they still get paid because apparently it's enshrined in law. Okay. But people who are going into work, they won't get paid until all of this is over. And non-essential workers, they just get sent home and they'll be put on unpaid leave. Now, in the past, they have been paid retrospectively, but you can't guarantee it because it depends on how long this shutdown lasts, because the furloughed payroll could cost around $400 million a day. So, that is an awful lot of cash. Markets have wobbled, I think it's fair to say. You could see it coming because we saw yesterday, ahead of the shutdown, gold hitting a fresh record high. And that is a sure sign that we've got people rushing towards those safe havens. As we record this, Wall Street futures are down. And one of the reasons, of course, is all the uncertainty. Markets hate uncertainty. And this is a particularly important time as well, because one of the things that we won't get is a huge amount of economic data. So we were expecting jobs figures on Friday. Very important at the moment to see the state of the US jobs market. We're also expecting some inflation data in the coming days. All those things which investors need to give them an indication about what's going on with the US economy. And of course, the US Federal Reserve needs in order to make its decision about interest rates. So, this is a really difficult situation. Obviously, it puts the US government in a really precarious position until they can get things agreed. And at the moment, finding agreement is looking really quite difficult.
Yeah, and I think I saw some of the posturing, if that's what you want to call it. There's a real worry that this could actually lead to job losses at the end of it. So obviously, there's people on unpaid leave at the moment. Is this going to lead to further job cuts and, like you say, further lack of confidence and uncertainty? Yeah, it's crazy times.
Do you know what brought it to an end last time after those 35 days?
No, I don't.
It was primarily down to queues at, the airports. So, of course, you still get air traffic controllers working, but a lot of the people that shepherd people through the airport, do all the checks, weren't working, and those queues, that grinding to a halt of those great big business deals and bringing tourists backwards and forwards, that was the thing that got people back around the table.
Oh gosh, I mean, we're big fans of queuing over here, but yeah, US immigration queues are bad at the best of times, let alone when no one is working them. But no, interesting nugget. Thank you, Danny. Um, Closer to home, we mentioned it's Labour Party conference week. I'm sure you've seen it all on the news, unless you've been living under a rock. Rachel Reeves delivered her big speech on Monday. I think, it's fair to say she's long been pitching Labour as the party of economic stability, keen to win over business and reassure markets. But her speech definitely lent on the theme of difficult choices yet again, those difficult choices facing the government and how the wider world has changed since Labour came into power. Danny, I wanted to ask you, how did the speech land? Did we get any kind of budget clues or any new policy announcements at all?
There have been nuggets, but I think it's fair to say that it raised more questions than it delivered answer, and it certainly sparked an awful lot more speculation. Look, Rachel Reeves herself said that some of that speculation is dangerous because people make decisions about their personal finances because of speculation, which might be detrimental to their personal finances. And we know that the Treasury often likes to fly those kites to see how things land. So, even though there's been a lot of criticism of journalists and the kind of speculation that we've seen in papers and on podcasts, and I think it is really important to stress that at the moment, most of it is just speculation, and a lot of the speculation which was talked about in the run up to last year's budget didn't happen. So, you know, take a pause. Don't believe everything that you see in the papers because some of it could well be that kite flying. But we have heard from Rachel Reeves that manifesto commitments on key taxes that working people pay stand at the moment. She's made conciliatory moves towards businesses, signaling that she won't come back to them for more tax hikes. But still, speculation that there could well be changes. After all, Rachel Reeves herself has said that the world has changed. And of course, VAT, that is a key one that people are talking about. So there is a possibility that maybe we won't see the headline rate changed, but the number of things on which VAT is charged could be expanded. We know that anticipated changes to Office for Budget Responsibility productivity forecasts are likely to make that black hole Rachel Reeves talked about often even blacker. Um, We've been also getting hints about extra spending, the lifting of the two-child benefit cap, pledge on youth unemployment, so those out of work for 18 months on universal credit to get a paid placement. If they don't get that, then the stick is that they risk having their benefits stopped. So there is quite a lot being discussed. There has been a lot of positivity. There's been talk about schools and libraries and healthcare and all those kind of things. But ultimately, we know that there will be those difficult decisions. And somewhere along the line, that circle has to be squared. And I would not be like for all the world to be the one with the pen here.
Indeed. Thanks, Danny. Now, keeping with the UK, GDP quarterly figures have been reconfirmed, with the period April to June clocking up a 0.3% growth rate. But this was less than 0.7% at the start of the calendar year. Um, those figures have been reconfirmed, but there's been some revisions for last year. Is that right, Danny? Is it good news or just not much to write home about?
Well, the revisions for last year were actually interesting because the economy grew more than had been thought after Labour came into government, and less than had been thought in the last days of Rishi Sunak's stint as Prime Minister. But overall, we're still talking about 0.1% growth last year, and the expectation of 1.3, 1.4% growth this year, depending on which forecast you look at, which is better than last year, but still subdued. Um, the big issue still is confidence, which is lacking. In fact, we had a survey from the Institute of Directors, which came out yesterday and showed business confidence at a record low. And there was some really interesting data, as you say, in these revised GDP figures about household savings rate. So the total amount of households' disposable income being set aside for savings for that cushion, just in case, the worst happens, rose in the second quarter of the year by 0.2% to 10.7% in the 3 months to June. So, real rainy day funds. I think a lot of that is because of concern about jobs. We've had a lot of posturing from businesses talking about a lack of investment, the fact that the increase to national insurance, the national living wage, would impact their ability to hire. We've seen that reflected in the unemployment figures. And of course, when people are saving, that means they're not spending, and that then impacts the high street.
Thank you. All right, turning to company news. Big news in from GSK. They've announced that Dame Emma Walmsley is to step aside as CEO in January next year. After nearly 9 years at the helm, she's overseen huge changes at the pharma giant, hasn't she?
She really has. And this caught us on the hop. It was a surprise. And an interesting fact, and quite a worrying fact actually, is that it takes the number of women at the helm of FTSE 100 companies to just 7. Back in 2024, we actually got to 10. So this is a big step back. But as you say, yeah, Emma Walmsley did oversee huge changes. She dealt with the pandemic. We've been talking about that because there are a lot of people at the moment that are suddenly coming up with COVID. And I've certainly had to go back into my cupboard to look for COVID tests in the past couple of days, which has been a real flashback. But she also spun off the consumer healthcare division, Haleon. She maneuvered the company back into the really lucrative area of cancer treatments. So she's made big changes, made the company more profitable, though we were looking at share price movements since she took over. And if you look at their share price movement, GSK's share price movement, and compare it with that of AstraZeneca, it's chalk and cheese. I mean, AstraZeneca's done incredibly well. GSK's done pretty well. She'll be replaced by her Chief Commercial Officer, Luc Miel, who has been with the company since 2017, so since she took over as CEO. And why? Well, she says that it's the right time to step down because 2026 is going to be the time when the next CEO will decide the path for the next decade. And it's true, when you look at the pipeline of drugs, there are a lot of those patents that come to an end. There are a lot of questions about what next. Obviously, we've got tariff concerns. We've got a big push by Donald Trump to manufacture more in the United States. Lots of question mark about pharmaceutical companies investing in the United Kingdom. So, a lot of big decisions to make. But it's worth saying that shares in GSK rose on the announcement. That had perhaps something to do with the fact that maybe people felt that a new CEO could bring a bit of fresh impetus, but the fact that it was someone being brought in from within the company meant that the turnaround would continue. But then we also saw that through again to the next day. And that had more to do with the fact that Donald Trump had announced plans to launch a government run website for consumers to be able to buy drugs directly from manufacturers. And it does feel like investors are sort of regaining confidence now in the pharmaceutical sector. There's been an awful lot of uncertainty about pricing and tariffs. And a bit of clarity there is really helping sort of regain investor interest in the sector. And they helped lift the FTSE 100 to a fresh record close yesterday. And if you look at the past quarter, the FTSE 100 has enjoyed its best quarter since 2022. So while we're talking about all this negativity about subdued growth for, gross domestic product, the UK economy, I think it's really important that we do mark the fact that, the FTSE 100 has done really well.
Yeah, and trading up, I think, as we're recording now. Going back to other job news, we heard from Exxon on Tuesday that it's going to lay off 2,000 workers globally, particularly across the EU and Canada, as part of another long-term restructure. Why is this restructure happening?
Some of it is the fact that they have been looking to consolidate smaller offices into regional hubs, part of a long-term restructuring plan. But some of it is down to the fact that we have seen the oil price looking really quite subdued. And Exxon is not the only oil company to be announcing thousands of job cuts as these crude prices tumble. That is down to the fact that we've seen increased supplies from OPEC and its allies. So we've seen Chevron, ConocoPhillips, BP all announcing big job cuts. But I think it is really notable, as you say, that most of those job cuts will come in either Europe or Canada and not in the United States, because of course Donald Trump's been a big proponent of drill baby drill, create jobs in the United States. So if we'd have seen Exxon cutting jobs in the US, I don't think that would have gone down well.
And a podcast favorite, Greg's, is back on the menu this week with its trading update. We're going to keep it brief, as we talked about them last week, and the marketing trick of opening a pub. Life hasn't got any worse for the firm, and that was enough to breathe a bit of life into the share price as a result of this update. But although trading has improved over the past few months following that profit warning in the summer, total sales rose 6.1% for its Q3, and that makes it 6.7% year to date. Cost pressures are also reportedly under control, but it still feels like fairly flaky foundations, and that Greg's might be growing a bit too fast in the face of headwinds. Um, we had a handy stat from our very own Dan Coatsworth. Greg's is, in fact, the 7th most shorted stock on the UK market. There's two kind of main fears behind this, I think. If the Chancellor tinkers with tax rates at the budget, there's a risk consumer confidence will deteriorate and spending on things like discretionary treats like Greg's will weaken. And another is the growing use of weight loss drugs. Might that lead to reduced demand for things like sweet treats, donuts, sausage rolls? Honestly, I feel like everywhere I turn, everyone is on or has been on one of those jabs. I don't think I'm enough to kind of singly prop up Greg's, but yeah, it's crazy at the moment.
I must admit, I'm a huge fan of a Greg's bacon butty and a cup of tea, because I don't like coffee and things like that. So I'd much rather go and do that. So I could possibly single-handedly prop them up. Couple of things that caught my eye in these results. One, that the most successful of the new stores seem to be in those sort of transport areas. So you get a lot of them at garages and that kind of thing now, which are going great guns. The fact that the store rollout has slowed down, which sort of plays into what you were saying about the fact that it might be growing a bit too fast. But the fact that it's slowing things down is also making investors sort of spooked a little bit. But in amongst all of this, although it says it's got its cost pressures under control, it has announced that it is raising the prices of some of its items on the menu. And the chief exec, Rasheen Curry, actually had a pop at Rachel Reeves, saying that a number of products are having to go up in price because of those changes that were brought in at the last budget, and saying it's really not helpful when something comes out of the blue like that and surprises businesses with huge costs that they weren't expecting, and saying, look, whatever you do in the budget, please make sure that you give people time to deal with those changes before they're brought in.
Yeah, and I think there's been quite a whole host of warnings across different sectors, especially retail, hasn't there? About, no nasty surprises again, please. Right, now it's time for this week's interview. There's been lots of talk over the past few months about investors looking beyond the US for opportunities. The world's changing rapidly as we make the transition to more sustainable energy, and demand for energy ramps up as AI becomes an ever greater part of our lives. As we teased last week, Danni, you've been chatting to Jacqueline Broers, Joint Portfolio Manager of the Utilico Emerging Markets Trust, which has just celebrated its 20th anniversary too. It specialises in infrastructure investment in places like Brazil, the Philippines, and Africa. Let's hear that interview now.
Jacqueline, for those who haven't heard, just explain exactly what the trust invests in.
Yeah, so UEM, first of all, UEM is a closed-ended investment trust. We've been listed now for for 20 years now. We just actually had our 20th anniversary. And we just have around 500 million under management. UEM is a long-term emerging markets investment fund, and that we are quite different than most emerging market funds, as we invest predominantly in listed infrastructure and utility companies. So that can be anything from listed port operators, airports, toll roads, water sanitization companies, waste disposal companies, renewable energy companies, telecoms, tower companies, and data centers. And so there's quite a mix of things that we can actually invest in. We are a very actively managed fund as well. We are bottom-up investors, and we are benchmark agnostic. We're not index driven. We're not driven by that MSCI Emerging Markets Index. We are looking for infrastructure and utility investments that may have been mispriced or undervalued due to market inefficiencies, or that may have been overlooked. And we're looking effectively or essentially for the best 60 to 70 stocks within emerging markets and the infrastructure and utility sectors that we believe can provide an attractive return for our investors.
So why emerging markets and why infrastructure in emerging markets?
Well, I'd say, first of all, the fact that we are infrastructure and utilities within emerging market is very much a unique feature. But if I look at first why emerging markets, there are a number of reasons why emerging markets. Emerging markets continue to have what we call the structural growth drivers in place. They have very positive demographics, i.e. sort of low age populations, who are becoming more and more increasingly educated. We have that rise of the middle class coming through. And as we're seeing the rise of the middle class, we're seeing consumption increase and therefore demand for infrastructure and utilities increase. And also, as we're seeing in emerging markets, increasing urbanizations. And typically, emerging markets still have relatively higher growth in GDP rates. And all this sort of packaged up, we believe, is sort of driving the need for infrastructure investment. Within emerging markets, emerging markets still require a hell of a lot of infrastructure utility investments. And that remains to be the fundamental backbone of emerging markets countries' development. And without it, emerging markets can't progress up that sort of value chain. Many emerging markets still lack adequate water sanitization, proper waste disposables, and therefore there is a lot of investment that we can do at UEM still into listed infrastructure companies that can go into these sort of emerging market countries and help them develop.
So what are the challenges here? Because I would imagine that regulation is probably a major one, and also making sure that it's the right infrastructure in the right places.
Yeah, and emerging markets have a number of challenges, and regulation is one which everyone sort of picks upon and says it has to be a challenge. But I suppose us as investment managers, that's our job, to be able to navigate these issues. However, I would argue that within emerging markets, governments are becoming more and more sort of increasingly aware of the need for infrastructure investment, and they can't go it alone. So therefore, they need sort of the private sector or investment from the private sector to sort of help with that investment. And that is really what we're playing at. But also I'd say, like, if you look at within our portfolio at the moment, just over 22% is within Brazil. Why Brazil? Because in Brazil, the government haven't, since the 20 years I've been working at 20 years that the fund's been operating and 15 years that I've been working at Utilico, I haven't seen one concession contract be ripped up. Yes, there may be amendments, but they will compensate the owners of, or the people that are running those concessions, to make sure that returns that they get are still the same or improved. So we learn over the years where is good to invest, where is not. Thailand, for instance, the regulatory framework is very challenging. So we tend to be sort of slightly underweight Thailand. And China, again, regulation can change overnight. But again, you need to really listen to what the policy is that the government is saying. If you're investing in line with the policy, that you'll be okay. But as soon as you start to see that change, you know that you need to start selling down those positions, because regulatory changes could be on the way. So that's what we're listening for and looking for where we invest.
And I guess that there have been a lot of changes just in terms of the way people view sustainable energy, particularly with what's been going on in America. So is that something that you're having to keep a really close eye on?
Yeah, the way in which we look at the fund, we also have the emerging market structural growth drivers, and then we have what we call these infrastructure megatrends. And one of them actually is energy growth and transitions. So yeah, there has been a sort of a shift, especially since Trump's come in, this sort of change in view on sustainable energy. But I mean, there's been a big shift within emerging markets themselves and what's going on within sustainable energy. I mean, it's been a sort of what I sort of see three drivers. I mean, there's drive for energy capacity. So as we're seeing emerging markets move up the value chain, demand for energy increases. So a lot of emerging market governments have had to bring on sustainable energy in order to be able to keep up or support the GDP growth that they want to keep sustaining. But also there's been a drive for decarbonisation, China by 2060, India to reach net zero by 2070. And there's been a big push, I suppose, towards sustainable energy to sort of move away fossil fuels. But then I suppose my cynical side comes in a little bit more. I mean, one of the big drivers for more sustainable energy has come through is energy security. And that's not been a sort of a Trump phenomenon. That's been happening over the last sort of five years, I'd say. And the catalyst really was the Russian-Ukraine war, when we saw fossil fuel prices or increasing. So therefore, countries that were very import dependent on those sort of energy sources, such as, say, India, the Philippines, saw higher fossil fuel prices coming in, oil prices coming in, inflation went up, and therefore that can't be sustained. They've realized they've got to be able to support their own economy through the energy sources that they generate, rather than having external or imported energy coming in. So that is something that's been a real big driver over the last few years within energy.
So you said you guys are very much bottom up. What do you look for in an investment? What is the thing which makes you go, yeah, that's the opportunity, that's exciting?
At the end of the day, I suppose it's the long-term return that can generate. We are looking for investments that can generate a sustainable long-term return for our investors. Typically, though, we love what we call the cash generative stocks. For instance, something that's linked with a concession contract that makes it, you can very much predict the sustainability of the cash flows over the life of that asset, because that then helps us also pay a dividend to our shareholders. But I mean, at the end of the day, it's the return of which the asset can to give us. I mean, we run a closed-end fund. We've got a limited pool of capital. It's very much a competition to get into the portfolio. If we buy something, we have to sell something. And so it's the return of which each of that investment can provide. And we are looking, like I said, for the best 60, 70 stocks that we believe will give us that really sort of high conviction sort of benchmark agnostic portfolio that can drive the best return for our shareholders.
We know that investors around the world are really excited at the moment about AI. It seems every day I'm talking about AI. One of the areas of investment in infrastructure that you look at is obviously digital infrastructure. So I'm guessing that AI plays a part in that.
Yeah, digital sort of AI feeds into what, again, this other sort of infrastructure megatrend that we have of digital infrastructure, which is now around 24% of the portfolio. But what we're really interested in is not the AI itself, but the infrastructure investment that supports AI. So things like data centers. I mean, some of the investments that we have, one in Hong Kong, for instance, is a data center called Sunny Vision. It's just bought online capacity for a new data center, and that is being taken up by these sort of large hyperscalers coming into Hong Kong that want to serve China, maybe US or Chinese companies as well. And again, why we love to be supporting the AI, then actually sort of investing into the AI directly, is that actually a lot of these data centers, when they sign contracts with the AI technology companies, they are signing sort of 10, 15-year contracts. So again, we can see the long-term reoccurring revenues coming through. But I mean, going forward, we suspect that, with the long-term AI boom coming through, there'll be more demand for mobile investments, fiber investments, tower infrastructure as well, all of which we're focused on and looking at opportunities at.
So that's the future and the now as well, I guess, in many ways. But just looking back, you were talking about 20 years. And what changes have been sort of the biggest ones that you've seen in terms of holdings and trends since the trust was created?
Yeah, I mean, over the last 20 years, I mean, there's been a lot of, we've been buying and selling. We tend to sort of churn around sort of 25% of the portfolio every year. But there have been a lot of trends, for instance, or changes. I mean, when we first started, if you look at a geographical split across the portfolio, Brazil was around 50% of our positions right at the beginning. That went round about sort of 10% in 2015, 16. Now it's popped back up again to 22%. And that's been driven by the opportunities that we are seeing within the infrastructure utility space. Malaysia, historically, 20 years ago, was a bigger portion of the portfolio. And now we only have one investment there. Just because the concessions that we're seeing, or the government have been a bit more apathetic in the concession contracts that they've put in place. And therefore, it's been difficult for us to find attractive investments to invest in. But I mean, there have been some steady eddies, as I call them. International Container Terminals, which is a Philippines-listed port operator, has been in the portfolio since day one. It's now number 3 in the portfolio and continues to provide a very solid long-term returns for the portfolio. But at the end of the day, I mean, there's a lot of challenges that keep coming in. I mean, the noise at the moment, the geopolitical noise that we keep hearing from every time Trump tweets something. But I mean, I would stress, there are a lot of noises going on. But I mean, at the end of the day, infrastructure utility assets are, I sort of cringe when I say this, are crucial for today's needs and tomorrow's innovation within emerging markets. So irregardless what Trump does, I mean, as I mentioned, we've got a company in Brazil that's a water sanitization company. Investment's going to go into that company over the next 5 years, doubling the size of the company. The return is on what we call RAB model, return on asset base. So the investment goes in, return comes out, and therefore all the noise we're hearing going on externally will not affect that investment. So UEM provides, I suppose, investments or resilient investment opportunity, and I continue to believe provides us, should be a staple investment trust within anyone's investment portfolio.
Thanks to Jacqueline for coming on the show. And thank you, Danni.
Over to personal finance now. It's your turn to talk. We have 2 important topics, Charlene. First, accessing tax-free cash from your pension. It can be tempting, especially as we mentioned earlier, when rumours about budget changes are swirling. But there is a huge amount to think about before making that move, Charlene.
Yes. I mean, leaving money in your pension until you need it is normally the best course of action. We love pensions, not only because of the tax relief and bonuses on the way in, but the fact when your money is inside that pension wrapper, it can continue to grow tax-free. And this reads across to, after you reach the age in which you could access your pension. If you leave the money in your pension, it can continue to grow tax-free, meaning you should actually be able to take a bigger tax-free cash lump sum when the time is right for you. So let's say your pension is worth £400,000 today, your maximum tax-free cash would be £100,000. Waiting until your pension hopefully hits £500,000, say, which may only take a few years with strong market growth, paying in some more contributions, that would actually give you an extra £25,000 tax-free. Look, it's one of the biggest decisions when it comes to your long-term financial planning. In simple terms, if you decide to take your whole tax-free cash, you will be removing it from that environment where it can continue to grow tax-free. Now, that might be completely sensible if you have a plan for what you want to do with the money. Lots of people like to pay off any outstanding mortgage, go on that big retirement holiday, have a big retirement party, or even help out family. But perhaps it's less sensible if it's going to then sit languishing in a bank account. If we're thinking about the environment where interest rates are stalling, inflation is sticky, and the amount of tax that people are paying on their savings interests is going up too. If you want to continue investing tax-free, once you've taken your tax-free cash out, the money could be invested in an ISA. We all have a £20,000 per tax year allowance, so meaning a couple between them has £40,000. But that might not be enough to cover the money that you're taking out. I don't like addressing rumours, and I don't know what Rachel Reeves is going to do in the budget, but I've said many times on this podcast and others, I don't personally believe that tax-free cash will be slashed, but that is my personal view. The reasons for that, it's one of the cornerstones of pensions. Changing it, I think, would be political suicide at a time when the government's under fire, and it would absolutely shatter confidence in pensions and long-term saving. There's an unwritten rule, really, that savers should be rewarded for saving towards their own retirement. You're often locking money up for decades and decades. And actually, it won't raise much towards filling any fiscal black hole for Rachel Reeves. A kind of last word on the budget there, but another thing you kind of need to consider is what happens if you change your mind. So once you ask your pension provider to pay a tax-free lump sum to you, you can't change your mind. HMRC has now confirmed to the industry that it definitely is an irreversible decision. It's really important that you're absolutely sure that you do want to take it out when you want to take it out before making that request. There are no cancellation rights, if you like. Some people might choose to pay back in some tax-free cash into their pension through making contributions, but there's a couple of pitfalls there to be aware of too. Firstly, the amount of money that you can pay or contribute tax efficiently to pension is limited. So there's two levers: tax relief, which is limited by your earnings in the UK, but there's also an overall annual allowance on everything paid in by you and for you, for example, from an employer. That's £60,000 a year for most people, although it can be tapered if you have a high income of above £200,000 a year. Or when it comes to accessing your pension, you'll trigger a lower annual allowance with the horrendous name of the money purchase annual allowance. Once you take £1 of flexible income, for example, from drawdown. So if you just took your tax-free cash but didn't actually take any income, you won't trigger this. However, if you do take a bit of flexible income, your annual allowance for pensions like SIPs, personal pensions, is reduced to £10,000 a year. So any excess above your annual allowance that you pay back in could face a tax charge. Also, you need to watch out for something called recycling rules. So these are designed to catch people out who up their contributions to get more tax relief by paying into a pension, using any tax-free cash kind of to apply that back into the pension. These rules are quite complex, and one of the conditions for you to face a tax charge is that HMRC needs to prove that you intentionally planned it. But if you are caught by the rules, the tax charges are potentially very high. So it's just one thing to be aware of. I think my message is, if you decide on balance, you still want to take your tax-free cash, it's the right time for you, the right time in your retirement plans. Please make sure you just have plans to use it to either fund your retirement or meet other financial goals with the cash. And also just keep in mind, it is a permanent decision. Make sure you understand all the implications for you, and including that it is not reversible.
I was just trying to think where I would go on holiday if I took a chunk of tax-free cash and I could go anywhere. Looking outside as it rains, it's quite tempting, but I'm paying attention, Charlene, and you're
I know
absolutely right.
it's a tricky one. I'm sat here telling people to potentially not do something or think twice, take a beat, whatever you say. And it really, really does just depend on your personal circumstances. I think just with it being such an important long-term, decision for your long-term plans, it's make it because it's the right decision for you at the right time, not on the basis of budget rumors. If you're in any doubt about whether it's the right thing to do for you, please speak to an advisor. This is what they do for their job. They look at your personal circumstances and advise you on the best course of action. If you're not quite ready to speak to an advisor just yet and you want some information on your options, we've obviously got loads of information on our website, but there's the government free pension-wise service from Money Helper. Jump online, you can make an appointment to speak to somebody. They can run through your options, but they can't actually tell you the thing that you should do.
Really useful. I also wanted to ask you about Now, I don't think these are actually surprising numbers from HMRC because over 750,000 matured child trust funds have gone unclaimed since holders started turning 18. So that's more than £1.5 billion just sitting there. And it is money that could really help young adults get started in life, but it's also something that many parents, in the fog of having their kids and then having other kids and them starting school and everything, have just forgotten about. They've got no clue where the details are, and they've maybe not even mentioned it to their kids.
Yeah, absolutely. So this week we've seen a warning from the government urging young people who are aged between 18 and 23 to check where they are actually missing out on this 1.5 billion pile of unclaimed money in child trust funds. Um, Child trust funds started maturing when the first children reached 18 from a few years ago now. What would it be, 2020? So just as after the kind of first main lockdowns. And this figure, this unclaimed figure, continues to grow. It's up 100 million since last year as more people with the accounts turn 18 and the people actually claiming them aren't keeping up with the people that are leaving them there. The average unclaimed account was worth just shy of £2,000. So this isn't just pennies we're talking about. And what really jumped out and probably highlights the issue of the fact that people have forgotten about these, more than 27,000 of the unclaimed accounts had a balance of £10,000 or more, which are just, if we all thought we had a pot of £10,000 somewhere, yeah, we wouldn't be leaving it unclaimed. And 280,000 pound 280,000, I should say, of these pots contained over £1,000. So these are accounts where the holder has turned 18 and they have not been claimed. They're known officially as continuing child trust funds. Lots of them do mature and they are claimed, but there's this massive black hole, as we talked about. And as you alluded to, most of these lost child trust funds will be because parents and children aren't aware that there even is an account. Over a quarter of the accounts, when they were originally set up, were actually set up by the government for the child concerned because parents failed to do so within their 12-month window. Back in the day, parents were given a voucher towards this child trust fund. So if they didn't set one up of their own accord, the government automatically did it for them, kind of like an auto enrollment, if you like. So there's a problem with the fact that parents might not know they even exist, or they might think they've got one, but they don't know where it is, what provider it's with, how on earth to track it down. So I think if you know someone who was born between the 1st of September 2002 and the 2nd of January 2011, they should have had a child trust fund set up for them. Or maybe you know a parent or guardian of a child in that group. Why not just mention it to them? And if they think that they might have a child trust fund and they've forgotten about it, or they just have no clue whatsoever, go to the gov.uk website and enter their details, and they can track down who their pot is with, how to get in contact with the provider, and most importantly, how to claim their money. Over 500,000 young people did that just last year. So it is working, possibly not fast enough because that black hole continues to grow. And a couple of words on kind of once you track down the money, it's up to you as that child who's turned 18, what you do with it. So you can transfer it to an adult ISA in your own name, or you can then withdraw the money. Until then, your money is just going to be sat in an account that nobody else has access to, possibly paying high charges. And one thing we did find when looking at this is it's been reported that a lot of the investment child trust fund accounts are paying high charges. But what we noticed with some of the cash providers is actually when these accounts start to mature, when the child reaches 18, they reduce the interest rate that is already quite low even further. So almost like a bit of a penalty for not claiming your money, meaning its value is just going to get eaten into by charges and inflation, whether you're an investment for charges or inflation for the cash version. If you or your child still has a child trust fund, they're still under 18, so it hasn't matured yet, hasn't fallen into this black hole, consider possibly moving it to a junior ISA, because that might mean you're able to reduce these charges. Some of these products do have high historical charges. And a junior ISA is much more likely to have a bigger investment choice. The money is still going to be locked up until you turn 18, but the tax-free benefits of an ISA will still apply to the money.
Really useful, Charlene. Thank you. Because there is a lot of money going unclaimed there, and both mine have child trust funds, and my eldest is 19, and we've got all the paperwork. and we haven't done anything with it yet. So I am one of those people in the black hole. So now I feel really
do
bad.
as I say, do as I do. Gosh.
That is it for this week's episode of the AJ Bell Money and Markets podcast. We'll be back next week with more news analysis and personal finance insight.
Yes, thank you for listening, and sorry for the sniffles from both of these COVID patients. Please don't forget to subscribe so you never miss an episode.
This podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell. The podcast isn't telling you if a certain investment is suitable or not. The value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.